How do you build that millionaire portfolio that everybody on the internet speaks about? Is it difficult? Is it easy? Let me tell you, there's one secret sauce I'm going to share with you on this video, how you can do it. And this video is for everyone, including if you think you're a super beginner, it's also for you. Hi, welcome back to Family Investment. If you're new here, my name is Alex Koh and I run this channel to help you build that confidence to get yourself into investing. And before I begin, please give me a like, subscribe and also comment at the video so I can know that you appreciate this. Today I'm going to show you the secret recipe and how to build it, and I'm going to give you 4 key examples which you can start today, and one of them is my own portfolio which I'm sharing that with you. I promise you that this will be a very easy method, simple, very sufficient for you to manage it yourself, and very little management, because at the end of the day, you and me, parents, families, you've got your own busy life, and the last thing you need to do is monitor it 24/7. But I want to give you some ground rules, some family ground rules for you to laser focus your objective so you can clear your mind of what you need to do. First step, rule number 1, the secret sauce itself is your top 3 stocks. Choose top 3 stocks, needs to be 75% total of your overall portfolio. It's all about high concentration. It's all about holding in volume. Where have you heard about the guy who became a millionaire owning just 1 or 2 stocks? Have you heard about the guy who became a Bitcoin millionaire just buying 1 Bitcoin? No. The people who became self-sufficient retired are the ones who bought in volume. The people who bought like 20, 30, 40, 50 Bitcoins. The folks who bought 1,000, 2,000, 3,000 Tesla shares. Those were the people who retired, not the one who just owned 1. And the second rule is one of the stocks within that 25% should be a dividend growth stocks. Yes, a future dividend growth stock is essential to help you diversify. Because at the end of the day, when you retire, you need something to generate dividend to keep the income going, to keep the snowball effect going. So it needs to be one quality dividend stock. And rule number 3, the 5th one that you hold needs to be a broad index. You need something to diversify, okay? You have your top 3, you've got your dividend, but you need something to diversify just to broaden up the spectrum on volatility days. And also, if you have an index, it's going to be low cost and it's going to be easy to buy when you've got a couple £100, you don't know what to do, then go buy an index or an ETF just to broaden the spectrum. Let's start with portfolio number 1, which is my personal style, my personal portfolio. And I am looking forward to retire in 2025. I am so laser focused, I'm so objective oriented just to keep buying dollar cost average these 5 stocks. So my top 3 stocks are, number 1 is going to be Tesla. Tesla is the biggest company in the world that's got so much innovation change. The growth spot rate for Tesla is more than 50% just now, and we are looking for potential 5 million cars to be delivered in 2025. Second and third are semiconductor stocks. Nvidia and AMD. I am so bullish on the semiconductor aspects. These 2 companies on this hyper charts here, you can see 50% growth and another 50% growth, because there is not enough to sustain the growth that we're experiencing in the world just now. We have got Internet of Things, we have got 5G, we've got cloud computing, you've got genomics, you've got artificial intelligence, and these 2 companies are in their prime era with great CEOs helping them to cope with the changes and mechanism to change. The 4th stock, which is paying dividend, not much but growing, and also one of the biggest companies in the world, it is Apple. Yes, Apple, as you can see on the sales revenue, they're still growing. Despite the fact that people pull them down on their phone, on their watch, but they're still growing in digital areas, they're still growing on their medical devices, future medical devices. Apple may be not paying good dividends just now, but I class them as future growing dividend stocks. More dividends pay out, and eventually it'll be the next Coca-Cola. So I'm going in Apple just now, holding them, and when I reach 65, I've got income generated. And finally, Taiwan index. I want something that's still growing, a country that's still growing, that's developing. And Taiwan is the best area, which I think for the internet generation, for the EV generation. And Taiwan has got loads of industrial companies in there that could generate great growth. Therefore, I've chosen them as my index growth. And now let's go for portfolio number 2. I call this the beginner's portfolio. It's for somebody who is just starting out, somebody who don't know about stock but knows about a couple of companies because you use them. I class this as lower risk, lower growth because all these companies have already growth, but they're steady cash flow, steady revenue, and it's easy to invest in this stock. So the first stock that I want to claim in this portfolio, it will be Microsoft. Microsoft is one of those companies growing great, it's everywhere. They have cloud computing, they have games, they have broad spectrum, they're paying dividends, great CEO, and still growing. And the second one is also another established, more than $500 billion worth. It could be Alibaba, it could be Facebook, it could be Adobe. These stocks are revenue generation stocks, but their revenue are below 20% just now. They're not great growing, the likes of Tesla, AMD, over 50%, but they're still growing. And slowly these stocks will start paying dividends in the near future. So buying these stocks are buying names that you know, household names that you use. And if anything happens to this stock, you know about them. So you don't have to worry because they're always on the mainstream. Finally, the third one would be Amazon. People laugh at Amazon because it's $3,000. But because we've got fractional shares with brokers and everything, you can own Amazon shares just now. There's nothing wrong with owning Amazon shares. They're still growing dividends. They've done well in COVID-19. The sales revenue is going. They have got cloud computing. They have got e-commerce stocks. They're everywhere. Amazon is one of the stocks which is cash rich. They have already peaked. They might still grow further, but it depends on how they acquire. And number 4, dividend ones would be Costco. You know, I've just been to Costco. I bought plenty of stuff. I mean, now after post-pandemic, Costco will be streamlining. They'll be selling. So the sales revenue is always in bulk, and they can afford with their membership fees to cover any overhead expenses. And last one, number 5, I keep it easy. It's going to be Vanguard's VOO. It's basically S&P 500. Okay, owning American stocks, owning American S&P, average growth of about 9% in the last 90 years, you will never go wrong with S&P 500. So if you want to spare cash, you don't know who to invest because you think other stocks are high, then top up your S&P 500. So now it's a halftime timeout. I want to give a shout out to hypercharts.co. The charts that you've been seeing on this video are from Hypercharts, and they have helped me in my investment journey. End of the day, I do not have the time to analyze every single quarterly calls, every single comparison. I use Hypercharts because it's visual. Visual tells you a lot of story. So check out Hypercharts, the link below, and it is really good. And now for the third one, I call this the Generation Z portfolio. So anybody who's born after 2000s, like my children, you should get this. Because end of the day, you want high risk because you want high growth type portfolio. There's no point investing in those old style dividend, but high risk, high growth. And if anything goes wrong, you can change it and you still can catch the train. But most importantly, if you catch them early, they will multiply even sooner. Okay, let's jump into the stocks that I will think which is good for you. So the first stock, I've got 3 names. It's going to be Snow, Twilio, or CrowdStrike. These are the internet type stocks. They've got cloud, they've got cybersecurity. So choose one. They're all high multiples just now, over 20s, 30s, and 40s. They look overvalued now. But if they do grow and they do achieve their targets based on the IPO pricing, these are really great stocks for future. And they will be looking cheap 10, 15, 20 years down the line. And number 2, Lemonade and Tattoo Chef. I like these 2 companies. Okay, Lemonade Insurance is easy millennial type insurance that you can buy off your phone. You don't have to speak to someone. You don't have to fill tedious form. Lemonade may be looking at really high growth, but the customer base is over 1 million and still be growing towards 2 million in the next couple of months. And then Tattoo Chef. Young people want to be healthy. They want to be meat-free in their food. They don't want to be vegan, but they won't have choice. So Tattoo Chef is one of those better than Beyond Meat because they're expanding, not just concentrating on meat, they're concentrating on desserts. They've got a large spectrum of food choices for young people that enjoy really healthy food. So Tattoo Chef has got lower multiples, great run, it's only worth $1 billion. How much room is there to run? Tattoo Chef will be the one if you enjoy their products. The next one, I like e-payment and I still like blockchain, Bitcoin. So PayPal and Square, 2 going head to head. Sounds like they're rivals, but in fact they're concentrating on different areas of growth. PayPal are straight to consumers, paying on merchant platform. But Square itself is using cryptocurrency and also focusing on the merchants for fast, cheaper transaction. And 2 different CEO, 2 different style, they are different. So pick your poison on which one you think will be growing. Okay, stock number 4 for portfolio 3 is going to be McDonald's. McDonald's is a generation stock. Revenue is going up and down, but they are innovating, they're changing, okay? They will be good changing with time, they're very adaptive. So McDonald's will be number 4. Dividends are growing, they'll be paying out dividends, and they will always be cutting costs. They'll always be moving, they'll always be expanding. So McDonald's is very resilient. And the last one, INRG. Green, green, green. Okay, we all hate oil, we all hate the pollution. So INRG is an index that focuses on green renewable. You got solar, you got wind, you got electric vehicles. So INRG should be the one for you to grow now, pay future value, but you pay dividends in future. Now for the 4th one, and I'm also excited about this. This is again for all ages, lower risk, but also lower growth. But who knows, in the next 5, 10, or maybe even 15 years, you will see great dividends payout. And yes, this is more of a dividend concentrated portfolio stock. First one, I want to call out again, semiconductor, Taiwan Semiconductor. The company is worth over 600-700 billions. It's still growing. Everybody in the world needs them. And guess what? They pay dividends, non-stop dividends. Okay, they're still growing. If you capture them now, Taiwan Semiconductor will be the one that's producing on an industrial level, and their dividends will not stop flowing. And number 2, I like Google. Google's got YouTube, and this is on YouTube, and I love YouTube. And Google is not paying dividend, they're growing, and they can generate so much revenue. It comes to a point where Google will just stay stagnating, and they will start paying dividend so they can secure our shares in the bank. So Google is not paying dividends, but I see them paying dividends in the next 5 to 10 years, and they'll start paying more and more dividends. And who knows, they might be the next Coca-Cola again for generation to come. And number 3, an European stock, Louis Vuitton MH. I love LVMH. It is still growing and they're paying dividends. I mean, where can it go wrong? It's growth, it's dividend, and what's going to be happening in future? It's just going to be even bigger. So LVMH is a luxury brand, and people pay good money for quality leather goods or champagne, and they have high gross margin. They do not sell in volume, they concentrate in the quality of stocks, and their stocks that they sell, the equipment, their products do appreciate in value. So it is a win-win situation. And the 4th one, a bit contradicting, don't pay you dividends, but it's growing and it holds a lot of dividend companies. It's Berkshire Hathaway. So defensive during pandemic, during crisis, and it holds one of the largest company in the world, and it's cash rich. It's got the lowest PE ratio in that spectrum. So Berkshire Hathaway is defensive, slow growing, but I like it. And last one is SPDW, which is similar to the S&P 500, similar to VOO. So again, get some index, broaden out the spectrum, and this index will hold loads of companies that pay you dividends. So these are the 5 stocks for this type of portfolio dividend style at number 4. For those who are not worried about growth now, but we'll see the dividend payout in the future years to come. So if portfolio dividend is fun for you, then number 4 is the one. So that's the end, and you tell me in the comment below if A, B, C or D is the one that's the most suitable for you. Which one do you like? So please click like and subscribe if you enjoyed this to help me grow my YouTube channel bigger. But if you want to join me, you can come and join me on free Discord channel. End of the day, it's all about us trying to generate that wealth to secure time with our family.
I hope you enjoyed that video. If you want to see future videos, please subscribe to the channel and press the bell button. Ding dong! More videos. Bye!